Hello, everyone, and welcome to this 11th colloquium from the Good Governance Academy. To let you know, the Good Governance Academy is a non-profit organization that works in the public interest to bring thought leadership together in terms of SDG for quality education on critical business issues in a collaborative manner, leveraging SDG. So welcome, everyone. Today, we're going to be talking about equivalence, and we've got some amazing speakers online to tell us all about that. Just to say that all of the functionality is open in the Zoom functionality. If you want to tell us where you're from, please let us know in the chat function there on your controls. If you can't see your controls, just press the Alt key, and then your controls will come up. We have also opened up the reactions. So if you like what we're saying, please show your love for the panel. I'm just going to show you. You can clap your hands. You can do thumbs up. Please tell us how you're feeling about what we're saying. And then finally, in the Q&A function, because we will lose some of your questions for the panelists, for the speakers today, please put your questions in the Q&A function, which is right next to the chat function. So it's lovely having everyone online. I see we've got people from Paris and Trinidad and Tobago. So of course, South Africa, Prague, Singapore. So from right around the world. We had over 1,200 registrations for today's event. And we've got a representation of 102 different countries people have registered from. So it's lovely, diverse audience today. And it's on a very, very important topic, because in this diversity, we're trying to create single sustainability reporting standards and looking at convergence of those standards. So I would like to now ask on the chair of the Good Governance Academy is Alan Johnson, past president of the International Federation of Accountants. And I'd like to ask Alan to open the colloquium. Then we're going to pass on to Professor King to tell us more about the topic. And then Neil Stevenson is online to tell us about the paper that's been recently published around equivalence. But first of all, without any further ado, Alan, over to you. Thank you.
Thank you very much, Carolyn. Good morning, good afternoon, and good evening to everybody, wherever you are in the world today. As Carolyn says, we've had over 1,200 registrations for this event, and I'd like to welcome all participants to today's 11th colloquium of the Good Governance Academy, and thank all of you, actually, for taking time from your very busy schedules to be here with us. I would first like to take this opportunity to recognize Professor Mervyn King, the founder and patron of the Good Governance Academy, for his very active work in striving for high quality and effective governance across the world. And this is something that he's been doing for more than 30 years. With his strong links with international institutions, with the universities, with business schools and professional bodies, and indeed many others, Mervyn has certainly got the attention of governments, of politicians, of business leaders and professions to drive higher standards of governance. And setting up the GGA as a not-for-profit organization that collaborates globally and shares information on crucial business issues is a public good and of significant public interest, and aligns, as Caroline has just said, with many of the United Nations Sustainable Development Goals. So today, this is the 11th colloquia. The previous ones included very relevant topics. Indeed, sustainable value creation, integrated thinking and reporting, the importance of ESG, corporate reporting and connecting financial and sustainability reports. And the last one we had was on risks and opportunities of generative AI. So today's colloquia will discuss and address the future of sustainability reporting and standards convergence. And we have an exciting agenda for today's session with two keynote speakers. So Neil Stevenson, who is the director at Deloitte in the UK, and Josephine Jackson, who is the deputy chair of the International Audit and Assurance Standards Board. We also have two panelists that will be joining me later today. Hilda Blom, who is the Deputy CEO of Accountancy Europe, based in Brussels. And we've also got Dr. Ihianyi Adihara, who is the Director of the Nigerian Financial Reporting Council, and he's responsible for accounting standards, and he also chairs the Adoption Readiness Working Group for Sustainability Reporting in Nigeria. By the way, both Hilda and Ihianyi are members of the Stakeholders Advisory Council to the Audit and Assurance and Ethics Standards Boards, and I'm also a member of that council. So it's good to be with them again today. After the panel discussion, Carolyn Chalmers, who you've met, who is the CEO of the GGA, will facilitate questions from the audience. So please post your questions and comments throughout the sessions. Now, we all know that apart from the risks of geopolitical tensions, inequality, social cohesion, falling trust in institutions, and many others, one of, if not the most significant issues the world faces today is, of course, the one that affects everyone everywhere, and that is of climate change and its severe damaging impact on human existence. Not a day goes by without these climate impacts being in the headline news, from floodings and drought in Kenya, Tanzania, Burundi, and other parts of Africa, to wildfires in Canada at the moment, and severe flooding in southern Brazil, in Indonesia, and yesterday in Afghanistan. And these are only in the last few days. All of these are leading to losses of lives and livelihoods, damage to biodiversity, and the collapse of natural ecosystems. So it is critical that companies everywhere set out plans to mitigate the impacts of climate change through tangible actions to reduce their carbon footprints and their endeavors to achieve net zero emissions over time. And reporting on these commitments, the plans to achieve them, and progress being made is of significant importance to all stakeholders. And the transparency and integrity of sustainability reporting is essential. And we will hear more on this from our keynote speakers and panelists today. So I hope you have a very rewarding colloquia today. We look forward to engaging with you, not only today, but of course beyond today. So with that, I will now hand over to Professor Mervyn King. Thank you, Mervyn.
Thank you very much, Alan, for that background about me and how you and I met back in 2006 or 7. And you were the speaker and you spoke about me and you came and sat next to me. And for the first time we actually spoke. So you were speaking about me and then you came and sat next to me. But the purpose of my speaking today as the patron of the GGA, of which I'm extremely proud, is to talk about the doctrine of equivalence. How did the doctrine of equivalence come about? And what are we actually striving to do in governance circles and in corporate reporting circles? We're trying to arrive at what I describe as the end game, to have a global comprehensive corporate reporting system so that we will be able to give greater weight to comparability, for example. We will speed up the financial transactions in capital markets. And we are all lending our weight drive towards this. And so we on the side of a river, and the river had become a river of alphabet soup river, but we need to cross to the bank on the other side, which is a global comprehensive corporate reporting system. This led to my speaking in 2019 in London when I said it was a social outrage that standard setters and framework providers saw themselves as competitors instead of collaborators under SDG 17. And this did galvanize some to talk about mergers, but it was really the pandemic where scientists collaborated and in 9 months developed a vaccine which would have taken 9 years. And this really motivated people to merge. And so the IR framework, for example, and SASB merged with the IFRS. The IFRS, after due consultation, established the ISSB, International Sustainability Standards Board. And but events were not standing still. For example, in the European Union, they had passed laws setting a timeline as to when the making of combustion engines in the EU had to stop. Plant and machinery couldn't be driven from an energy point of view with fossil fuels. And countries were starting to develop standards of off-balance sheet issues, sustainability reporting, ESG factors. And there was fragmentation in sustainability reporting. The ISSB has developed S1 and S2, the two standards, one of general requirements and then climate change, which is of critical importance, as Alan has already pointed out. But it also has the principle of interoperability, so that if you and I are online with the directors of a company speaking as a collective, we would have to make a decision to report something which is material in the broad sense that it could change the thinking process of the user from a risk-reward ratio. And this collaboration became driven by the merger of SASB, IR, and the IFRS, and the establishment of the ISSB. The principle of interoperability enables a company which has adopted the ISSB standards, or a regulator has regulated that is the standard of sustainability reporting, left room that if there is something which is material, which is not covered by an ISSB standard, that you could, for example, use a GRI standard to guide you to report on that issue, which is material in the sense that it could change the thinking of the user. Way back decades ago in research, equivalence became important when researching various things. And then it moved into the legal world, especially in regard to patents. When a patent holder alleged that the defendant was copying his or her patent, the court developed two principles. The one was that of substantial difference, and the other one was of insignificance. So if it was alleged that the defendant had copied the patent holder's patent on a certain product or writing, the court would say, this is not substantially different. And if it's not substantially different, then you've breached the patent holder's rights. Or it would say it is so insignificant that it has been no breach of the patent holder's rights. This principle crept into financial reporting. But before the establishment of the IFRS, we really had a patchwork quilt of financial reporting standards. It took the private sector to establish the IFRS, which eventually we had approximately 150 countries following the IASB standards under the IFRS. So a more comprehensive framework for financial reporting. But here again, we still had numerous jurisdictions which differed from the IASB standards. And especially when you had a conglomerate, for example, say in France, adopting the IFRS standards, and a subsidiary in another jurisdiction, say Morocco, adopting another form of standards of financial reporting, but it was so equivalent in the sense that substantially it was the same. If not substantially, there was insignificant difference. That the external auditor and or the regulator would say that there's no need to actually qualify this report in any way whatsoever. It actually substantially complies with what we want here in Morocco as well. This, of course, helped the burden of financial reporting when a conglomerate had, let's say, 30 subsidiaries. The same thing, the doctrine of equivalence, working with interoperability, can hugely reduce the burden of trying to report a French company, holding company, with 30 associated or subsidiary companies in different jurisdictions and different standards of sustainability reporting, and could reduce this burden, but at the same time make it easier from a comparability point of view. So putting the two together, this principle of interoperability and the doctrine of equivalence, will just be another stepping stone towards what I've described as the end game, a global comprehensive corporate reporting system. So it's important and a critical business issue. As we've done in the past, our last colloquium went through our 181 support members who are great institutions in themselves. For example, the International Federation of Accountants or the Institute of Chartered Accountants of England, Wales, IOD, UK, IOD, India, etc. The summary of what happens at this colloquium today will be done by Carolyn, edited by me, and it will go out to our 181 support members, who will in turn send it to their support members, their members. And our last colloquium, summary of the last colloquium, went to 4.5 million accountants, companies, other professionals around the world in 137 countries. So the very purpose of my founding the GGA and marrying SDG 4 and SDG 17 has been achieved. And we continue today by taking this, what I believe is a critical issue, this doctrine of equivalence, when it comes to sustainability reporting, because it will speed up the question of comparability and just another step towards that global comprehensive corporate reporting system. So thank you very much for being online today, and I look forward to the panel discussion, speakers, and I look even more forward to summarizing it all and sending it to our support members so that it literally goes around the world. Thank you very much.
Prof. King. I'd like to hand over to Neil now, to Neil Stevenson, to give us an overview in terms of the concept of equivalence and where that's going in terms of sustainability reporting. Thank you, Prof. King, and over to you, Neil.
Thank you, Karen. I think you're going to share some slides for us. Can I just check you're able to do that? That's amazing. You might need to, that's it, perfect. Thank you so much. Well, I'm absolutely honoured to be here at this colloquium today, and really thank you for this very kind invitation. And it really is a particular honour to speak following Professor King. I mean, Mervyn, your inspirational leadership has really changed our perspective around the world on governance and reporting, and we now understand the importance of integrated thinking and reporting as a result of your strong leadership globally. And Alan, delighted to see you today. I mean, you exemplify the role of the professional accountant in business, so it really is an honour to be speaking here alongside you too. So if we can go to the first slide, please, just to the agenda today. I'm really elaborating actually on what Mervyn has guided us through. That was a masterly overview of, I think, the current state of play. So I'm planning to start by reminding us about this idea of vision for a comprehensive corporate reporting system. And in doing this, I'm going to draw on papers that were published by Accountancy Europe back in 2019, and the work of the group of 5 leading sustainability standards published in around 2020, and also an article published by Veronica Poole, who's the IFRS and corporate reporting leader at Deloitte. And I'm drawing on Mervyn's endgame as well. While the main focus of this presentation is on global alignment, if we're going to evolve from where we are today, we need to be, I think, clear about where we're going to get to. So I shall articulate a little bit about that vision. I shall reflect on where we are today in relation to the work of the International Sustainability Standards Board, and assess the progress towards the idea of a global baseline of consistent and comparable information. I shall consider whether the developments in mandatory sustainability reporting requirements around the world are leading us towards an aligned approach or to a fragmented system. I shall outline some potential tools that can support an aligned system, including interoperability and equivalence, and very briefly, I shall reflect on some steps that companies need to take to make sense of the emerging system. So let's go on to the next slide, please. I really think it's so important that whenever we make these presentations on reporting, we keep reminding ourselves, and Alan, you elaborated this already, the overall objective is not reporting, but addressing the major crises that affect our world and planet. And successive studies highlight that time is running out. And these studies also highlight the scale of the financial investment that must be made into sustainable business. And I'm aware that financing the transition continues to be at the top of the policy agenda, and I understand it will be a focus at COP29 again this year. However, while reporting for its own sake may not be the overall objective, it is nonetheless a key enabler, and we therefore do need a system that promotes trust and transparency and achieves high quality information to support the decisions made by investors and stakeholders more broadly. And we need a system that recognises the foundational importance of integrated thinking. It promotes a global system and an end game that facilitates companies integrating people, planet, prosperity for society into the core of their business and allows them to focus on what matters. Now, these developments respond to continuing investor and broader stakeholder concerns about trust and confidence in reported sustainability information, including transparency on the actions being taken to support climate and sustainability commitments. So while there's been a lot of developments, and I shall go through some of those, the reality is we still have a lot to do to get to the if you like, the quality of information that's needed to support this system. So maybe if we go to the next slide, it's clear that we need to put in place a reporting system that can support all of these objectives that I've just set out. But what are the principles that should inform this system? And here I'm very much drawing on the Accountancy Europe paper and the work of the Group of 5. So as we can see on the screen here, a number of principles. These are not meant to be exclusive, but they illustrate some principles for a system that we need. And I think the first of these is that we do need a global approach to achieve a global baseline. And that's fundamentally because business, their value chains, capital markets, and in fact, the sustainability issues that we're facing are all global, and we therefore need global solutions to them. But we do need the flexibility to allow for top-ups to reflect public policy priorities as they become adopted around the world. We also need a system that allows addressing reporting on sustainability matters to investors and reporting on sustainability matters to stakeholders more broadly. Both those groups need to have their particular information needs satisfied. To achieve this, we do need an independent standard setting approach that leads to high quality outcomes with appropriate due process and oversight. And we do need, Mervyn, as you talked about, that interoperability so that as far as possible, the definitions, concepts and disclosure requirements that are adopted are consistent between different requirements. We do need the connectivity with financial information and connectivity more generally across corporate reporting. And this is a really important request that and call that investors have been making for a number of years now, and indeed was the basis of the Task Force for Climate-Related Financial Disclosures. And finally, but definitely not last, we need a system that promotes integrated thinking and a focus on material issues. And to put it in a different way, we want one that facilitates that integration into the business and not one that leads to a compliance mindset. So if we move to the next slide, this sets out a potential blueprint that is consistent with these principles. If you've attended prior colloquiums, you may find that you've seen this before. It's certainly something that Veronica Paul presented at one of the previous colloquiums. So this vision allows for a global baseline of sustainability information relevant to investors and accommodates a system for reporting to stakeholders more broadly. It's based on existing well-regarded independent standard setting bodies, and it's a vision that can readily be applied alongside the other necessary parts of a well-functioning corporate reporting ecosystem, including the training, the professional development, assurance, enforcement and monitoring. And so I do think this is a plausible vision. As I said, it's based on many of the ingredients that are here today, and some of it's already been achieved. As we were talking about, the ISSB has been set up and it sits alongside the ISB, and that's already consolidated in a number of other frameworks and standards. So I think we should keep this vision front of mind as we now go on to consider where we are today and assess progress towards the aligned system of the future. So where are we today? If we move to the next slide, please. So many of you will be aware that the ISSB has made very quick progress since it was formed back in 2021. The ISSB standards are designed to form a global baseline of consistent and comparable sustainability information useful to investors and providers of financial capital. In IFRS S1 and S2, the ISSB has published the essential elements of the necessary reporting infrastructure, including standards setting out the general principles for reporting and specifically topical standard on climate. The requirements include a framework for companies to report on the sustainability related risks and opportunities that could affect their prospects over the short, medium and long term. So this is not a climate standard, it encompasses climate, but it's a broad set of framework that allows for reporting on all sustainability related matters. And the ISSB is now developing its agenda to build out its topical standards in critical areas such as nature and biodiversity and human capital, and it is already working to enhance its industry standards based on the SASB standards. So following the publication of the standards, IOSCO, the global regulator or the global body of member regulators, endorsed the ISSB standards last year and called on its 130 members to consider ways to adopt, apply or otherwise be informed by the ISSB standards within the context of their jurisdictional arrangements. And a very important announcement came from the Financial Stability Board when it said that the ISSB standards, and it found that the ISSB standards should serve as a global framework for sustainability disclosures. And now TCFD has been disbanded and the FSB has transferred the monitoring of climate-related disclosures to the ISSB. And this development really reflects that IFRS S2, the climate topical standard, is strongly based on the TCFD recommendations. And indeed, there is wide stakeholder support for the ISSB, including policy support at the level of G7 and G20, and a lot of business support. 400 organisations at COP28 called for the ISSB to be used to form a global baseline for climate reporting. And here at Deloitte, we've been working with a coalition of companies through the World Economic Forum for a number of years, and those companies have advocated very strongly for a global baseline based on the ISSB standards and actively engaged with the corporate reporting ecosystem to achieve this, including through high-level dialogue at Davos. Now, I think the best way of building the global baseline is for the ISSB standards to be adopted in full without modification within jurisdictional requirements. This approach still allows for jurisdictions to add further requirements in respect of their specific public policy priorities. And indeed, we should understand that there will always be a need for that kind of flexibility because every jurisdiction will have its own set of sustainability priorities. But we do think that adoption is essential. And we are starting to see strong moves already for adopting the ISSB standards, and that's less than a year actually since they've been published. And they're doing that either directly or via local standards that are effectively bringing in the ISSB standards. And we're seeing this already in Australia, Brazil, Canada, Japan, Malaysia, Nigeria, Singapore, South Korea, and the UK, to name just some. And so these are all very positive developments. However, if we move to the next slide, please. However, we are also seeing the risk of a fragmented system. So while we are seeing good levels of adoption and progress towards adopting the ISSB standards, we are noticing that there is a tendency to bring them in via the development of local standards that are based on the ISSB standards with the introduction of adaptation, modification or carve-outs. This does lead to a modified set of standards, and that there is a risk, therefore, that we could end up with multiple versions of ISSB-derived sustainability standards around the world. The second big issue here is that other jurisdictions developed their own standards and requirements, notably in the US and the EU. These requirements have significant extraterritorial reach. In the case of the European Sustainability Reporting Standards, companies in scope will be required to report on the company's impacts on sustainability matters and how sustainability matters affect the entity's development, performance and position. The double materiality concept that will be familiar to many of you. In other words, while emerging requirements are said to be globally aligned or are derived from the global standards and frameworks, in practice there can be significant differences in reporting requirements, including on the concepts and definitions, measurement and presentation. So we do see a risk, therefore, that we could in fact move from a patchwork of voluntary standards and frameworks, Mervyn, you described it as a river a moment ago, just after we have seen promising consolidation. For example, we saw the consolidation of CDSB, the SASB standards and integrated reporting into the ISSB. And we could move from that patchwork to a new patchwork, a patchwork of regulatory requirements. To use that much loved phrase, moving from one alphabet soup to another. Such fragmentation not only detracts from the concept of a global baseline, it can also detract from decision useful information by switching the focus to compliance away from material sustainability information that is overseen by the board. Fragmentation also increases the efforts required for companies to comply with all the different requirements. And we should be recalling here that complying with even one set of sustainability reporting requirements is not a small challenge. Companies will have lots to do to achieve a robust approach necessary for high quality reporting, including extending their governance and internal controls to build a much broader data set and, where required, to get that information assured. This task becomes much harder, complex and costly if multiple jurisdictional frameworks have to be complied with. And I think there's a bigger risk too, that users themselves can no longer see the woods for the trees, resulting from complex and voluminous reporting and a flow of inconsistent or incoherent data flowing into the market via different requirements around the world that lead companies to report variants of the same thing. This outcome is not likely to help accelerate a more efficient allocation of capital to sustainable business. So what tools do we have to promote an aligned system? So perhaps we move to the next slide, please. Thank you very much. So as I said earlier, and I think it's really important we keep this in mind, the preferred way to build a global baseline, certainly in many of our views, is that the ISSB standards should be adopted in full by jurisdictions. But we understand, and I've just outlined, there are different requirements coming through around the world. And so what tools do we have to promote an aligned system as we see this emerging picture? And to what extent can those approaches help to achieve the global baseline? So I'm going to talk about two approaches that can be helpful and assess how helpful they may be. So one approach that is often talked about is interoperability. Interoperability refers to the ability of a company to meet different reporting requirements efficiently and with less duplication of effort. Standard setters and regulators may seek to achieve this by aligning concepts, definitions, requirements, measurement and metrics as far as possible within their overall objectives. And we have seen this approach in practice in the interoperability work between EFRAG, the European Sustainability Standard Setter, and the ISSB, which has led to the recent publication of guidance. Now, this guidance illustrates the alignment of the respective climate requirements in ISSB and ESRS. Now, such guidance is hugely welcome to preparers. The alignment of the ISSB's definition of material information and ESRS's financial materiality is a strong basis for the guidance, and it will definitely support companies when they are thinking about moving from reporting under ESRS to ISSB or reporting from ISSB to reporting on ESRS, or whether they want to accommodate both sets of standards within their overall reporting. GRI, you may recall, has also confirmed that companies who apply the ESRS standards will meet the with reference to provision in their standards. And so there are some good examples of interoperability in practice. However, exercises to highlight interoperability between standards and regulations actually really result in reconciliation tools. Interoperability does not mean that if a company meets the requirements of one standard that is assessed to be interoperable with another, it has complied with the other standard as well. So companies therefore have to make sure their disclosures comply with the requirements of each set of standards or regulations that it either wishes to apply or is required to apply. And I think that's one of the key things we must very much keep in mind with interoperability. And if we think about the emerging landscape that I've just described, we could enter a very complex world in which interoperability guidance is issued between each different set of standards and requirements, even those based on existing global standards. So, for example, do we need interoperability tables between the global ISSB standards and interoperability guidance with jurisdictional standards that are adapted from those standards? And we could end up with a taxonomy of taxonomies. And I hardly need to add that this leads to the risk that sustainability reporting becomes an extensive compliance exercise focused on reconciliations, rather than a key transparency tool focused on material matters and supporting the big sustainability climate crisis that we want to solve. So that's, I think, where we are on interoperability. So it's very useful, but it perhaps has a limitation. And indeed, some of you will recall that the various sustainability frameworks and standard setters came together some years ago under the International Integrated Reporting Council as a corporate reporting dialogue to promote alignment between their respective approaches. Now, that initiative was visionary for its time, but the outputs effectively formed guidance that offered companies a map to help navigate the different standards and frameworks, and companies still had to apply each standard or framework that they wished to comply with. So we can draw a lesson from the past here and understand that interoperability only offers a partial solution. Another tool that can be considered is the legal concept of equivalence, and it was fascinating to hear Mervyn talk about the patents and that idea of substantial equivalence. This is a well-established concept in many fields, but certainly in the world of financial reporting. So, for example, foreign preparers are allowed to use the ISB accounting standards when they are in scope of the SEC's rules, so they don't need to adopt the US GAAP. So, under the principle of equivalence, regulators permit companies outside their own jurisdictions to use globally recognized standards to meet corresponding jurisdictional requirements. So adopting such an approach would allow companies to use the ISSB standards to satisfy various jurisdictional reporting obligations around the world. Now, this would certainly be feasible for jurisdictions that have adopted sustainability reporting requirements that are variants of ISSB, or perhaps where local requirements are already aligned to TCFD, which, as I've already mentioned, IFRS S2 clearly builds on. So equivalence could be one means that would allow multinational companies to fulfill multiple requirements using one set of standards. However, we would need to make additional consideration for the approach in jurisdictions that require a double materiality approach. In other words, thinking about the impacts the company has on the environment and the impacts that the environment, people, planet, etc. have on the company itself. And of course, this is the case in the EU, which has adopted that concept and put it right at the core of its reporting requirements. So the ISSB standards, as we know, do not require reporting on impacts that are not determined to be financially material. But equivalence could be a viable approach in the EU, and certainly the CSRD expressly leaves open the possibility of recognising an equivalence. The Global Reporting Initiative GRI standards, which do use that impact lens, could be helpful in this particular area. Many companies already voluntarily report using GRI standards, and many of those are now looking to adopt the ISSB standards. That's because they will either want to adopt them voluntarily because their shareholders wish them to adopt them, or because at the jurisdictional level they're required to do so under a local regulation. And so one solution here could be if compliance both with the ISSB and the GRI standards could be recognised as equivalent to reporting in line with the requirements of the CSRD, and for the many foreign companies and groups that are affected by its extraterritorial reach. So if the concept of equivalence were to be introduced in this way, not only could it help to achieve greater global comparability, but it may help limit the amount of time and resources that companies invest in compliance activities to meet multiple requirements and reconcile different disclosure requirements. This in turn could serve to enhance decision useful information. So I've presented two possible approaches to help us accelerate moves towards a globally comparable and consistent approach. So there is much to do to achieve the comprehensive corporate reporting system, I think, from what I've been saying. We all have a role to play in advocating for a coherent system that helps address the big issues of our time, including the climate crisis. But if we move on to my final slide, please. In the meantime, while we all busily advocate for and all of us take steps to put in place this global vision, the companies have got lots to do today, right now, to get ready for the mandatory requirements that for many are already coming into force. And in many cases, for example, under the CSRD, companies will be in scope from this current reporting year. So companies are certainly now thinking through their corporate reporting strategy in light of the various mandatory requirements they must now comply with. To support this, companies will also need to enhance the reporting processes, including governance and internal controls over sustainability information. This will be especially important when companies need to get ready for mandatory assurance over their sustainability disclosures, as is the case with the CSRD. As a result, sustainability is increasingly on the agenda of audit committees in their role overseeing risk, the integrity of the reporting and the assurance policy. And sustainability reporting, we observe, is fast coming under the oversight of the CFO and the finance function, given this regulatory aspect of the reporting, and that it's increasingly now in the mainstream corporate report. But, and I want to end on this point, in order to achieve high quality sustainability reporting, the most important step for companies will be to enhance their integrated thinking and genuinely bring consideration of people, planet and prosperity for society into the core of their business. This should help boards to maintain the focus on the material issues. In other words, the matters that underpin and drive value creation that in turn enables long-term sustainable business in the move to a low-carbon sustainable economy. So I'm going to finish there and thank you so much for your attention today and the opportunity to present.
Thank you very much, Neil. Lots and lots of really insightful and important information. Got a couple of questions. Let me just first of all post two questions that we received on email. The first question is the idea of a global baseline of consistent and comparable information achievable, or is it just a good idea?
I mean, I think this goes to the core of it. I mean, you know, visions are visions, and we need to strive for them, don't we? So, and then we have to think, well, is it actually achievable? I think the first thing is it's really important we do have that vision strongly in mind, that we do need to get to it for all the reasons we set out, and we must remember the bigger picture. I think it is achievable ultimately. I think we have to be positive. If we're not positive, we certainly are not going to achieve that vision. But I think we may have to accept that it's not going to happen, you know, this year. I think it will take a few iterations to get there. I think, as I said, we have some tools in the toolbox that can help. But I think as these requirements start to be implemented by companies and we start to see the practices, and perhaps as different jurisdictions start to think through how they can fit with other jurisdictions in this area, we could see some stronger progress. But I think to say it's going to happen today would be wrong, but I do think it's achievable, and perhaps it goes to the core of the fact that that vision that we set out does all build on what exists today. It doesn't need to, you know, you need to adapt, move things around, etc. But it's not unachievable. All of the ingredients are there.
Thank you, Neil. I'll take some from the floor now. This one from Lynn Johnson. ISSB is seen as targeting the 1% to 5% of the global business population. But as such, small businesses have been virtually ignored. Small businesses lack the tools, times, and capacity to make changes that would make reporting of any value. Do you know of any plans to address this challenge? I think thinking then off the top of my head of the SME, standards that are available in the IASB.
Yeah. So I think this definitely is a tricky area in the sense that the reporting requirements that are coming through all require that consideration of the value chain. So ESRS, ISSB. So that does in fact mean that the large companies in scope will be asking throughout their supply and value chain for that data. In terms of the ISSB practice, which is what I'm most familiar with, firstly, I think it's important to say that the standards were designed with a proportionate approach in mind. So there are reliefs from a number of things that are likely to be more complex from companies. So for example, if you're unable to calculate the financial effects of some of the risks and opportunities, you can say that you can't do it. If scenario analysis is too difficult for your company and its circumstances, you can state that and not perform the scenario analysis. So they've tried to be proportionate in the approach they've taken. And they've also launched a capacity building framework and program to do precisely what you're suggesting, that need to help the whole system move into this new world, if you like. So some of that thinking is there. And I also note in the ISSB's agenda paper, where they were looking at their future work plan, one of the considerations was in fact the burden, if you like, on SMEs in terms of some of the themes they were choosing, in terms of how much information the standards would require asking throughout the whole value chain. So that's very much on the mind of standard setters. But I do think we need some more practical tools that perhaps help us to get the information perhaps in an easier way, because I do accept that for small business this is a big thing. I think I would say that the while the ESRS is actually has quite a low threshold, many companies are in scope, private companies, and I'm sure Hilda you'll talk about that later, but many private companies are in scope of the ESRS. But certainly I think for ISSB primarily it's going to be implemented through, if you like, the listed and the PI sector first.
I have a question here from Carty Lewis. It's a shorter question, and I'll get to Catherine's question. Carty's asking, how would companies apply the double materiality assessment methodology in the ISSB context when they only need to comply with financial materiality reporting? How do you see those two concepts of materiality playing out in a reporting process, so to speak?
Yeah, I think, as I was saying in the presentation, perhaps the most important starting point is that the description of financial materiality in the ESRS standards is consistent with the description of definition of material information in the ISSB standards. And the interoperability guidance that I just referred to, clearly says that there is potential for an aligned outcome. I think the important thing is, I think there are 2 points to make on this. Firstly, I think when companies are doing their double materiality assessment, really to think through, when they're thinking about their impacts, for example, really to think, are these actually financially material over time? So really to think about that strong overlap between impacts and financial materiality. And then when thinking about the ISSB, think very strongly about the need to focus on investor lens and to think about the matters that could affect the decisions of stakeholders. I think the key point here is you can't automatically just say, because I've looked at it under one standard, I can apply it to the other. But so you need to think through the requirements of both standards. But there should be substantial alignment at the level of financial materiality under both standards.
Thanks, Neil. From Catherine Garcia then, what are the advantages of reporting according to the different platforms if a company is required to the CSRDs and ESRSs? What are the advantages then of reporting according to different platforms if you actually still required to report under ESRS? And she's just commenting here, it just seems an extra burden for companies. The CSRD and ESRS are very robust, and wouldn't companies be better off in addressing the issues, impacts, risks, etc., rather than spending so much time in reporting against all of these different standards. If regulators in the EU are not using the interoperability concept or have addressed it already during the preparation of the CSRD, and I know that the term equivalence is actually a term in law in the EU in terms of addressing the non-EU companies' standards of reporting. So I guess this is going to a question of experience. What are the advantages of considering other standards, even if there is a compliance requirement for these companies to adopt and report against the ESRS standards and CSRD?
Yeah, so I mean, one of the critical things here is the ISSB is trying to create that common language that will be recognised by providers of financial capital, and so there's likely to be strong demand from investors around the world to understand clearly what those, what the ISSB and reporting under ISSB. I think that's going to be absolutely crucial for many companies. And indeed, as I was suggesting earlier, in many jurisdictions, ISSB is going to become a mandatory requirement. In fact, the UK government has just announced today its next steps, if you like, towards UK adoption. So I'm not sure it's either or. I think in reporting we've always thought about not just what we're in scope of under regulatory requirements, but what our users of reporting want to see and what they're asking for. I think the crucial thing here as well is under ISSB is that, if you're including other information, you shan't obscure the information that's relevant to the investors. I think that's one of the key principles that we need to hold in mind here. As to, I think, the implication that would we be better off addressing the risks and opportunities and impacts rather than reporting about them all. I think there is some, well, let's put it this way. The trust and transparency equation is, to my mind, absolutely critical. If we're going to make progress, the accountability for the commitments made, the performance of the company, the clear and transparent reporting without undue bias, etc., is all very, very important to in itself to facilitate the decisions of the users of the reporting. So I don't think it's either or, but as I was suggesting, the more we can promote that consistent and aligned global system, the more it is efficient for companies, and therefore the more time they have to devote on really bringing those matters into the core of their business. So that's the purpose of that vision, really, is to help direct the energy to transparency about what the company is actually doing to address the big issues.
And I'm going to call out Peter Duffy of the ESG Exchange and call his name in vain, but he speak about, and it's actually quite an important concept, is that you're reporting against one standard and you come out looking, and he uses, obviously being Irish, St. Patrick's Day green, and then you're having to report against another standard, and suddenly you maybe a slightly more paler shade of green, as in the sick green, because it's not looking so good. Just the different reporting organizations go about, addressing those kinds of, interoperability issues, I guess.
Yeah, I wasn't
between
sure
the different standards.
I'm not sure I fully got I got a little bit of a time lag in the middle, Pip. So if you might just ask the question again.
Sorry. So you report against one standard and you're looking great. You report against another standard and you don't look so great. How are users of these reports going to reconcile those two differences without calling greenwashing?
Yeah, well, when this goes to the core of why investors and many stakeholders want that one language, because that means that there is that one depiction that is consistent and comparable of the company. It's unbiased, it's balanced, it's like all of those things that enhance trust and transparency. But I think we should also remember that the source of complication for many companies is the ESG ratings and indices, which some have different approaches, methodologies, and remits. So they take the information that they obtain and then put it into all of those different benchmarks, etc. So that also can cause some confusion. So I think the notion of trying to get as far as possible to one set of a baseline set of information does directly address that risk, and in some ways it can call out greenwashing. I think the risk is that if we do have lots of different presentations of the same thing, this can actually enhance the risk of greenwashing, because it could mean that you're able to mask certain differences or variants in one compliance statement that doesn't come through in another. So yes, there is that risk, I think, of greenwashing. And so again, I think the idea of that one consistent story, one consistent communication language does actually help to address that issue.
Great. Thanks, Neil. We've got quite a few questions, and I'm happy to take them if you're happy to continue.
I'm happy to, but I don't want to spoil the panel's remit.
Yeah. Per countries and regions, that I'm going to park and leave that for the panel, because we have got the diversity of countries and perspectives in the panel. So to go to this question, the biggest issue that needs to be addressed, hang on, this is location specific. Here's one from Peter. Would it be fair to say that the interoperability equivalence gap challenge is one that is best assessed at the level of data points? For example, do we need to replicate the recent GRI ESRS data point mapping tool in the context of an ISSB ESRS mapping, and perhaps starting with IFRS 2 and E1?
Yeah, so the interoperability guidance that was published by ISSB and EFRAG does go to a very high level of detail and right down to the individual requirements. And to some instance, it does discuss the actual data points that are associated with those requirements as well. So I'd say it is already very detailed and welcome, because they've worked really hard to come up with, if you like, their shared view of how the two different sets of standards fit together, with the aim of making it, avoiding duplication of effort by companies, making preparation easier, etc., etc. So that has been very helpful. But I suppose the point I was making earlier is, if we do that for every different requirement around the world, we're going to end up with a very, very complicated map that will lead to, almost reporting by flowchart and technology if we're not careful. And while they're very helpful tools to help us get to the right answer, and we should definitely embrace any form of technology that helps, make the reporting better, more efficient, more effective, etc. I don't think we want reporting by those sorts of reconciliation tools. I think what we want really is what Paul Druckmann, formerly of the IRC, always talks about, is data in context, to understand how these data points describe what's going on in the company, its strategy, its performance, the value that's being created, etc. So I think it's really important that we sort of don't see all of those very detailed tables as a great big answer without thinking about, well, how is it really speaking to the bigger picture? So I think that'd be my first overall point. But it does also speak to the fact that even when you do detailed alignment at the data point type level, the way that they may be applied or prepared or thought about could vary according to the concepts and the definitions and so forth that are elsewhere in the standards. So some of the general requirements, for example. So I think it's really important we don't just see this as about, metrics and measurement. It is about that, but it's also about that whole bigger picture of what's the objective of the standards, what are the key concepts that are being applied, what do I need to think about in respect of connectivity with other parts of the reported information. It's a much bigger picture that we have to think about.
And of course, then, I mean, on the complete opposite level is you've got data points, but then, as you mentioned, the IRC and Paul Druckmann's quote there is that you've got the integrated thinking, and you mentioned it earlier, and integrated reporting that really pulls it to the opposite extreme now, and that is the story of the company, of the organization, as opposed to the data points themselves. And so it's perhaps giving more insight into the intentions and future direction of the organization. I've
Yeah,
got another
and
one.
that's
Yeah,
why,
sorry,
if I
Neil.
can just say, Karen, I think that's why certainly when I presented that slide that Deloitte has used a lot, this idea that when we talk about integrated thinking, we kind of deliberately use the pillars that TCFD and now ISSB have adopted for their core content, the governance, strategy, risk management, metrics and targets, because that really forms a very good framing for the integrated thinking that needs to go on in the company and links nicely to the reporting framework as well. And I think that's a really important and useful way of thinking about what we're trying to get to. So in that regard, metrics and targets are one critical core component of that whole.
Yeah, because we've got the 4 pillars, of course, of the TCFD that has gone into ISSB and reflected in the ESRS as well.
Correct.
I've got another question here, or statement from Lynn, that I'm sorry I moved into the answered bucket, but we didn't actually answer it. She's saying, we have been reviewing reports and found that many err on presenting the overly positive story. And that was my point about the St. Patrick's Day green versus the not so feeling healthy green. When tensions on climate change and other environmental issues continue to grow, because they are, there are more and more cases of greenwashing being tabled. And this undermines trust in so many ways. Lynn's asking, do you see the adoption of ISS standards to actually being able to counter this?
So I think the answer is for both ISSB, ESRS and other requirements that are coming around the world, they should all have in mind that sort of trust, and they all have in mind that idea of transparency and unbiased, balanced reporting. So I think that's core to all. So whether you're applying ESRS or whether you're applying ISSB, that's very much the intent there. I think the answer, though, really is to see it as part of that broader system. And I didn't really talk about, if you like, the wider system, if you like, outside the direct corporate reporting standards. And I think what will make a difference is, as standards become mandatory and are therefore adopted within regulation, you need that whole system around it. You need the training, the assurance, you need the enforcement and the monitoring at the level of the regulators. And so there's a whole system that needs to come in around it, as we do already see. So if I'm familiar in the UK, for example, the UK regulators have already been putting out their appraisal of TCFD reporting that's required by the Financial Conduct Authority. So they've already been looking at the quality of those disclosures, and they are calling out things that they do not believe are consistent with the requirements of the TCFD framework. And that's the kind of thing that we can expect to see as we go forward. So the assurance can provide additional confidence to the users that there isn't that undue management bias. And certainly when I read the Series report earlier this year on investor expectations of assurance, they were very clear that that benefit would be very strong if applied to sustainability disclosures. But then that also goes into the regulatory expectations and the actions and steps they take. So I think that's
Thanks,
the point.
Neil.
If we
That's
bring
really
it into the core, bring it into the mainstream, if you like, we do bring that system with it.
Yeah, and it really, the devil's in the detail. When we actually start applying this, we'll start seeing the issues come through, I think. I got one from MJ here. MJ is one of our, she's well known in the sustainability world, also committee members in the ESG exchange. MJ is asking, can you articulate what you envisage in terms of applying the doctrine of equivalence to sustainability reporting standards? She's got a couple of questions, but let's just stop on that one. So can you articulate what you envisage in terms of applying the doctrine of equivalence to sustainability reporting standards? What would you see?
Yeah, well, we've yet to see it directly in relation to all of the sustainability reporting requirements that are coming out. There is some reference actually for the California bill, which would permit ISSB for part of the acts that they've put out. But I think the core idea here is that there are two methods here. Either one jurisdiction can say anyone who applies and is in accordance with ISSB or ISSB plus GRI would fulfill a particular requirement in our jurisdiction. And typically that's used to permit foreign filers of foreign companies investing in a particular subsidiary or whatever in a country to enable that kind of equivalence that makes it more efficient for them to comply with local requirements. The other approach is where two jurisdictions, each of which has its own sets of requirements, sit down and they say, well, do we see that there is substantial equivalence between our respective requirements? Or maybe we see substantial equivalence, but on one side there needs to be additional disclosures to make it substantially equivalent. And then that's a basis of agreement is determined that then is enacted that enables companies to use set A to fulfill the requirements of set B as well. So the effect of equivalence is I only have to comply with one set of requirements, and that is deemed by a third-party authority to meet the requirements in another jurisdiction. So that's how equivalence works. Under interoperability, I'm saying I have to do set A and set B, but I've got lots of useful tools that help me make it as easy as possible to do that. Under equivalence, you only do it once, effectively. So that's where I think it is helpful. It does take the thing on a whole step, because it means you don't have to produce, as you say, the different shades of colours on the same matters. You do one thing once, and an authority deems that it meets their requirements.
Ah, brilliant. So MJ is asking what needs to happen. Securities regulators stating so in regulations, and I think you kind of answered that in terms of you have to get together, you have to agree what is equivalent and what you could use and what additional metrics you need to report on. So it is very much at a regulator level.
Or a policy, it could be a policy level as well. Sometimes this goes in through law, but yes, whoever is the oversight authority of those particular requirements, yes. In other words, we as companies cannot decide whether we think something's equivalent or not. We make that decision. It needs to be a formal decision between jurisdictions, or a jurisdiction allowing certain requirements.
Here's a difficult one, and I've got just getting to the last question. Sorry, Neil, we've really put you on the spot here. While we've got you at hand. There's just a quick one. What is your opinion, your personal opinion, regarding different standards approach to materiality and double materiality, impact materiality? How should boards go about approaching this concept of what is material from a sustainability perspective for their organization?
Yeah, well, this really goes to the Group of Five paper, which did set out a kind of what was described as a nested and dynamic approach to materiality, which recognised that sustainability reporting can be to stakeholders who wish to understand the contribution, positive or negative, that a company is making to sustainable development, but can also be to inform providers of financial capital about the risks and opportunities that could affect the prospects of the company. So those are legitimate, two different kind of understandings of what users would like to have from sustainability reporting. I really like that visual because I think it recognizes that many impacts are relevant to investment decisions, and sees that you have, if you like, a population of impacts that a company has, and of which many of those will be relevant to investors, providers of financial capital. I also really like the way it's described in the GRI Universal Standards, where they talk about, impacts over time traveling to become financially material. So there's that kind of, again, setting out that dynamic nature. And I think it's really, really important when we think about climate change. Many of those impacts that companies have on the world are direct risks and opportunities that investors wish to understand. It's not either or. I think very often they're if you like, two sides of the same coin. What investors want, though, is a clear articulation of what those risks and opportunities are, bearing in mind that many of those derive from the impacts companies have on the world. And, for that reason, just some very obvious things that are already included in ISSB's thinking is Scope 3 emissions. That whole effect through the value chain, which is a direct, or it's actually an indirect impact throughout that whole value chain, that is deemed important to investment decisions. That's a kind of illustration as just to how far the impacts companies have can be relevant here. And to bring it to perhaps a more simple example, I like to often think of fishing stocks. It may be that there's a finite number of fish that can be taken from a particular source. every time I fish as a company from that source, I'm depleting the stock of fish available. So it is a risk and opportunity. I'm certainly impacting nature and biodiversity, and many stakeholders want to understand, well, what is that impact? And rightly so. From the investor point of view, that's still an impact that's going to be very relevant to them, because at some point there are no fish left. So I think we need to stop thinking about it as either or, but very much in terms of what's the type of information on the impacts, the effects that we are having within that ecosystem that are going to be relevant to a set of users that wish to understand the effects on sustainable development versus those that are really trying to understand from a provider of financial capital perspective.
Thanks. Last question. You talked about equivalence, and this is to get your deep insights. You talked about equivalence as one way to support the global baseline concept. But you've got some ideas on how it should roll out. But do you know of what steps are actually being taken in this direction?
Not yet, and I think it comes back to many and I haven't got an answer here really. I think many countries will probably wait to see emerging practice and how it seems sensible to take things forward. But certainly, the CSRD includes that possibility. The SEC did not go down that route in terms of its current rule that was put out and currently stayed, but nonetheless did not shut down that possibility. As I mentioned, the California bill does permit some equivalence. So I think it's not yet there in place, but it is sort of, if you like, in the thinking. This in the ecosphere thinking, if I can put it that way. I think the reason for raising it now, though, is it's something we should be all encouraging and suggesting as a good way forward that brings about that consistency and comparability. And that's the kind of thinking that does actually shine a light on this as an opportunity to achieve the bigger comparable, consistent information type equation. So I see it in that regard. So I think it's very useful to consider it now and put it forward as a good thought and idea, and then we'll need to see developments as they go forward.
Thank you, Neil. And thank you so much for staying on the spot for us. It's been really great to get these questions and to get your answers, because I think, and we'll write them up and put them on the event page, because they're questions that everybody has. I think they're not specific to any country or jurisdiction. So thank you very much for that. We are, and yes, thank you. Please show your emojis, clap your hands, give a high five. That's lovely. Thank you very much, Neil. We are going to go into a 10-minute break now. And then after that break, so please stay on the line, but go and get yourself a cup of coffee, a glass of water, have a body break. I know for some people, specifically on the west coast of the US, and I see that there are some people here, it's very, very early for you. And for those in New Zealand and Australia, it's really quite late for you. So very late for you. So thank you very much for staying online. We are going to take a 10-minute break. Actually, let's just make it till 25 past. And then at 25 past, we'll introduce Josephine Jackson, who is the Vice Chair of the International Audit and Assurance Standards Board, just to get an insight and perspectives in terms of applying those standards across all of these different multiple sustainability reporting standards that we have out there. So Neil, thank you very much. And we're going to take a 12-minute break. Great. Thanks so much.
Hello, everyone. Welcome back. We're just waiting to see if Josephine Jackson is joining us. If you just give me a minute, I'll just check.
Hello, welcome back. We haven't got
Hi, Alan. Sorry, we can't hear you. Alan, can you try that again? No, sorry, we can't hear you. It could be your earbuds. Do you want to just try your no, we still can't hear you, Alan.
He's on mute, Perry.
Yes, he's just unmuted now. I think he's just getting the earbuds. Thanks. Alan, can you hear us? I'm just seeing if we can't get Alan back online. In the meantime, let's start off with the panel discussion. Hilda, Inyani, if you could turn on off mute and then turn on your cameras, that would be great. Yes, Alan and Josephine are AWOL. Alan is coming back. There's Alan now.
Yeah, yes, we haven't got Josephine
Want
yet.
to try that? Yes.
Okay.
No, but you're back online. Thank you.
So if that's okay, can we just switch to the panel session? Ihani, Hilda, is that okay with you?
Yes, that's
Oh, that's
definitely
great.
fine by me. Thank you.
Thank you so much. Really appreciate your flexibility. I know Ihani is very busy today. Ihani, are you okay to go?
Yeah, I'm ready. I've been waiting for you to come back.
Thank you.
Good afternoon.
Well, I think I temporarily lost the line, so thank you very much, everyone. So welcome back. I hope you've managed to have a short break and refreshments, etc. So we're going to move into the panel session, and as I mentioned earlier, we've got two esteemed colleagues with me, both Hilda and Hiani. We're going to sort of have a conversation together, and obviously, please post any questions you have in the questions on chat box, and we'll do our best to deal with them. Let me just first start with Hilda. So Hilda, I mean, a lot has been discussed this morning on CSRD and the ESRS, etc. Maybe you could just briefly sort of share with us, the European Union's progress on sustainability reporting.
Good, I will try. Thank you. First of all, thank you for the invitation to speak today. And I would say good afternoon from Brussels, as they say, the heart of Europe. Let's see if that's true. So on your question, so indeed, reference has been made to the CSRD, the Corporate Sustainability Reporting Directive, which became applicable as from this year, 2024. So that's a law that requires in the European Union, first of all, for all European countries that are listed countries and companies and that are large companies, sustainability reporting, mandated sustainability reporting. A large company, it means by and large more than 50 million of turnover in euros. Good. That is as far as the requirements. There are requirements for non-EU companies. There are a lot of people from non-EU countries on this panel. So there are also extraterritorial requirements. And for non-EU companies that have more than 150 million of turnover and that have a branch or a subsidiary in Europe with a turnover of more than 40 million, they are also underneath the scope of the CSRD. So there is this effect. In Europe, as from 2024, listed entities have required sustainability reporting under the ESRS, the European Sustainability Reporting Requirements. Those standards are applicable. There is a first set of 12 standards, really ESG standards. There are 2 general standards, one with general requirements, one with general disclosures, and then there are 5 E standards for environment, climate, pollution, water, biodiversity, and circular economy. There are 4 standards on the S, the social standards, own workforce, workforce in the value chain, affected communities and consumers, and then the G, there's 1 standard, business conduct. So these standards are there, they are applicable, they are mandatory as from this year for listed entities. As for from next year, for 2025, they are also applicable for the large entities. This is about 50,000 companies in the European Union by the end of 2025 that will need to apply those standards. These standards are in European law, so that is there. If we talk about the non-EU companies, then the story becomes much more interesting and very much on topic of the colloquium today, because there is a possibility that Europe would look at standards, to set standards for non-EU companies, but there is indeed this alternative of equivalence. So this is something that is not yet decided, and that is going to come next. One thing that I want to add, as if 12 standards are not enough, they are demanding standards, nearly 300 pages, not 100 disclosure requirements in total, but not much less, and more than 1,000 data points if your materiality assessment would tell you you need to actually apply all of this. So just saying this is a set of demanding standards. As if this was not enough, the work is being done now on sector-specific standards. So by Maren lies within 2 years, by June 2026, there will be nearly 40 sector-specific standards, first starting with the most polluting standards. For instance, that's what is being looked at is oil and gas, mining, also agriculture, road transportation, those textiles as well, those standards. There will be sector-specific standards. So if you are in those sectors, within 2 years, you will also have to use and report under those standards. So that's the overall picture we are at in Europe right now, and what is going to come in the near future.
Thanks. So what are you picking up in terms of the responses from the companies, given that the applicability is starting now? And I know one company that actually decided to start the work on this, and as you've pointed out, it's a lot of work, very demanding. What is the accountancy you're picking up from the companies, so the corporate side, in terms of how they're approaching this?
Mm-hmm. Well, first of all, I was just stepping out because I realized I left my window open, so that might have given some noise disturbance. So hopefully that's okay now. So first of all, the companies that need to report under those ESRS as from 2024, the listed entities, so basically the public interest entities, listed entities, banks, insurance undertakings, they had non-financial reporting requirements before, since almost 10 years. So that is important to point out. They had those requirements. There were no required standards, but they have experience with sustainability reporting. These are the companies that do not start from scratch. They might have used GRI, they might have used integrated reporting, they might have used TCFD, or a combination of different frameworks that were available. Some of those companies have been doing this for actually quite a while, and these are also the companies normally with most of the resources. You know, they are often quite large companies. So they obviously knew that this was coming, so they have tried to prepare in advance as much as they could. But we have to add, only in the second half of last year, the ESRS were ready. So there was not a lot of time between having the final standards and having to apply them. So they have hired resources, they have studied the standards, they have started and done with their stakeholder engagement, they have done, and they are working on their materiality, their double materiality assessment, which if they have done GRI before, they might have some familiarity with it. If they have not, that might be newer and more difficult for them. So there is a level of preparation that was already there, but the requirements now are, you know, much faster and much more demanding. I would say it's a journey. They are doing what they can. Setting up data points is taking resources, is taking time. They might not fully get there, but they are trying. They still have, you know, about 7 months to hopefully get there. So most of the companies that we talk to, they have, you know, really set all the means they can set onto this to get there. They will hopefully be capable of using some phase-ins depending on what your company, and there are some phase-ins, so especially related to the value chain, which is actually quite important in the first 3 years. But will the first set of reports that we will get by April next year be perfect? I don't think that anybody can expect this, as this is a journey. There was, for instance, no field testing of the ESRS. So there is actually some guidance that is being worked on, but there is not yet that much available at all. So it is a little bit a leap into the unknown for a lot of companies. And so there will be a level of trial and error, which, well, we think would be fine. Now, let's see what enforcers will think about that.
Thank you. Let me come to you, Ihanyi, because I remember in October 2022, I think it was, when I was in Abuja as part of an IFAC mandate, and I visited the FRC, and I met the chief executive, and you were there. And the FRC of Nigeria made a very strong commitment to adopt the ISSB sustainability standards in the country. So maybe, you know, 18 months on, maybe you could just share, and there are a lot of people from Africa on this call today. Maybe you could just share the progress that you're making and what, if any, are the obstacles and challenges that you're seeing now.
Thank you very much, and my sincere appreciation for the opportunity to be part of this unique and wonderful program. Yeah, Alan, you are taking me back to memory lane when you were part of the annual accountant conference and our visit and receiving you. Yeah, I recall that a lot have taken place after your visit in October. In November, the Financial Reporting Council of Nigeria signified their intent to early adopt the ISSB IFRS S1, S2 during COP27 at Egypt. And we mentioned that Nigeria was ready, in collaboration with other stakeholders, to adopt the IFRS S1, S2. Subsequent after that, the Financial Reporting Council of Nigeria established what we call the Adoption Readiness Working Group. because we wanted to walk the talk. That we signified that we are going to do that, we had to put a lot of things in place. And the Adoption Readiness Working Group is a multi-stakeholder group. We are the preparers, the assurance providers, the regulatory bodies, the civil society, all the relevant stakeholders in sustainability-related issues. We are brought together to brainstorm and prepare a roadmap. Shortly after the inauguration of the Adoption Readiness Working Group, the International Sustainability Standard Board launched their first two standards on June 26, 2023, and Nigeria happened to be one of the 6 countries that were selected to launch the standards simultaneously. After that, we had the group work tirelessly to issue an exposure draft on the roadmap, which was unveiled at the floor of Nigeria Stock Exchange. We gave the stakeholders about 42 days. Since a lot of them were part of the group, but the entire stakeholders were given some more time to look at the proposals. And we really got some cogent, some well thought through comments. And we reflected those comments. And on March 22nd, when we had the privilege of hosting the chair of the International Sustainability Standard Board, Emmanuel Faber, and his team, we launched the roadmap. So in Nigeria now, we have a guide that will say, this is when we intend voluntarily early adoption and mandatorily reporting sustainability as part of corporate reports. The roadmap, if you permit me to explain a little bit further, we have 4 phases because there was this critical issue. Do we have a bank option or do we have a phase option? And the way I talk about it is when there is a rush to enter into a trend that's likely going to be stampede. So we decided to have phase by phase approach, considering the capacity, the technical capability of entities and the sectors of the entities. So because technically in standard setting, early adoption means starting before the effective date of the standard. So we were able to get few entities that were classified in the first phase as early adopters. Those whose effective dates were before the January 1, 2024. So such entities are expected to issue their sustainability report on or before June 2024, based on IFRS S1, S2. The second category, let me just be fast so that I don't waste too much time, is what we call voluntary adopters. That is from 2024 to 2027. We ask all public interest entities to assess their capability and get back to FRC. So the third set is mandatory adoption, and that is in 2028. However, we have 2 categories in the mandatory adoption. We have the PIEs, the public interest entities, and we have the small and medium enterprises. The public interest entities are to mandatorily implement IFRS S1, S2 from 2028, while SMEs are given 2030. And the other group is government and government organizations. We have not determined their effective dates, as we are waiting on the International Public Sector Accounting Standard Board that is still working on developing sustainability standard for public sector. Are there challenges? Of course, there are challenges. And the first challenge we have, to me, is challenge of mindset. Because we are approaching the sustainability from the practices, looking at changing corporate behavioral practices. So that if you get it right, if you have in your strategy, in your governance about how to reduce emission, you subconsciously put all efforts towards the reduction, not towards reporting. So at the end, what you will be reporting is what you are doing. So the major problem is entities having the mindset to abandon what they have been doing and do what they ought to do. That is number one issue, and we are tackling it with advocacy. We're having massive advocacy to let them know. Another major problem is cost. Entities are looking at the cost implication of building new infrastructures, both in reporting and both everything. So the third issue we have is technical capacity. So for me, they are there, and there are provisions towards alleviating such challenges. We have a lot more. Let me pause here.
Thank you, Henry. And it's very interesting, the point you make about the mindset. And in fact, somebody's posed the question to Hilda, but I think it's not just to Hilda, it's to all of us today. And it's from Nusrat Ibrahim, who says, is the world going to be a better place with so much disclosure requirements? Is it going to help heal the planet, people, and increasing prosperity? And that's exactly the point you're talking about in terms of mindset. And Neil mentioned it earlier, which is about the actions taken. It's not just about the reporting. Reporting sort of helps tell people where we are on the journey. But if all your reporting is that you're still at the station and the train hasn't moved, then you're not going to make much impact. So it is about addressing the core issues. Is the world going to be a better place? And there's also an interesting comment raised by Richard Ndebele, who talks about the weaknesses of sustainability standards. And he goes on to say that research indicates that in practice, they currently do not effectively support strategies that ensure equitable value distribution. And I talked at the beginning about inequalities, et cetera, et cetera. So in all of this, what we've got to make sure is that it's not just about the reporting, but actually tangible actions to make the world a safer, more equitable, better place for all. At the heart, and I think Neil also touched on that point a number of times. But if I could just stay with you, Iheanyi, because I know that last week you were in Mauritius at a Pan-African meeting to discuss sustainability reporting and other related matters. So how would you say that is the continent gearing up to address the challenges that you've just referred to? Hilda also mentioned some of the challenges to address, one of the most pressing and urgent issues the world faces.
Yeah, thanks so much. You are right. We had what we call Pan-African Regulatory Roundtable on sustainability reporting in Mauritius last week. And I think, in my assessment, is one of the best moves we have ever made to have a united Africa towards any global initiative in this regard, because AFIA is an association of African Forum of Independent Accounting and Auditing Regulators. And these are the regulators that will, let me use the word, require jurisdictions in Africa to implement this sustainability standard. And that gathering revealed a lot. There are countries that have been doing so much in the sustainability reporting journey, that are not in the public knowledge. And there are so many who also have not even known how to start. So they gave us opportunity to leverage on the activities going on around African jurisdictions in the spirit of nobody should leave the brother behind, the African Union. So we met, we looked at what is happening in Europe, which I cherish so much. There is no standard issued in accounting, auditing, or so that Europe won't have a common voice. And that is what we AFIA tried to do last week. We identified some jurisdictions that require assistance, and we did something like pairing them with some other jurisdictions that have gone a little higher in the implementation. And we agreed to sustain that. And we also require that there should be jurisdictional, how will I use it, options, not really stampeding any jurisdiction into doing it. But in all, it gave us an opportunity to try to be on the same platform in implementing sustainability reports.
Excellent. Thank you so much. So staying with the theme of actions, Hilda, so we know that the European Union is introducing the cross-border adjustment mechanism, or CBAM as it's known. Could you please share with us what you believe are the, maybe you could explain what CBAM is, because I think it would be relevant. It is absolutely relevant for the world if they want to trade with the EU, and also what you believe are the challenges and the opportunities therein.
Good, thank you, Alan. First of all, going back very much to the point of transition, and here we're talking about sustainability reporting, and fully agree that by just asking for reporting, you might not change behavior, or you might not instill action that you're looking for. Now, in Europe, there is what they call the EU Green Deal, which has many sub-aspects. And one is the CSRD and sustainability reporting, but there are many others, because the whole setup, the reason why we have the Green Deal is to actually have as its main aim a transition to sustainable business models. So that is the ultimate aim. And, this is just, put into different actions. Before I get to CBAM, there is one that actually was approved only a few weeks ago, and it's the CS3D, the Corporate Sustainability Due Diligence Directive. And that is what we would call the action point, because it is actually via due diligence requirements, it is asking for a certain scope of companies. They are not exactly the same as the ones under CSRD, but to actually take action as far as a list of environmental matters and human rights matters. So the action is taken care of via this. The reporting is for the CSRD, and I'm talking here about companies mainly in the European Union. Now, when we talk about the CBAM, the Carbon Border Adjustment Mechanism, what is the idea behind this? In Europe, we have already the ETS, the EU Emissions Trading System. That's for European Union companies. And as a company, you could say, in Europe, all those demanding requirements, why would I continue to have my production there? I just go outside of Europe and I don't need to do any of this. The CBAM is what I would call the response to that, and it is to actually provide a level playing field to what the ETS is for EU businesses. The CBAM is what companies that want to trade with Europe and want to import products within Europe, that they would eventually come under the same requirements as far as greenhouse gas emission as European companies are. So it is to avoid EU businesses relocating production or obtaining imports from third countries that have lower standards to start with, especially as far as greenhouse gas emissions. So it's what they call to have no carbon leakage. There are, of course, as all those things, it's quite a complicated matter. There are two first main parts to it. Until the end of 2025, there is the whole reporting mechanism that needs to be set up. It's basically for those companies that want to continue to import and trade with Europe, that they demonstrate, what is their greenhouse gas emissions. As from 2026, the aim is that if they have not lowered their emission to a acceptable level, that then they will have to call, certificates, they will have to pay. So that there is some offset that can take place. Now, this is a European Union initiative, but as from 2027, the UK will have a CBAM. It's not necessarily the same words, but the content, the requirements are very, very, very similar. So Europe might have been first with this, but it is not the only one that actually will have such an approach. And if you really, those things have no borders, as we say. So if you want to have a transition worldwide, this type of approach makes sense, because otherwise you just replace the problem to somewhere else rather than to solve it. So that is the idea behind this. For the CBAM, it's challenges for sure. It's complicated. We believe that a lot of companies are currently trying to get to grips. What does that mean for us? Normally it's the importer, so the responsibility is for the European companies to take care of this. We understand that many of them, they work with specialized agents, like you work with a customs agency for that, and so they try to sort out the paperwork. What obviously everybody hopes is that this is used to actually lower greenhouse gas emissions, rather than to say, well, we just go through the paperwork and whatever we have to pay, we pay. But it is a little bit too early to really talk about what in practice the real challenges will be, because companies are still going through that. The opportunities, definitely the main opportunity is to lower greenhouse gas emissions. That is the main objective and opportunity that we have here.
Yeah, and that kind of addresses a point that Lynn Johansson has actually made. She's been very active today, I have to say. Thank you, Lynn. Because she talks about the gap between what the urgency that the climate scientists are telling us and the actual change that we're seeing at the moment. And how do we close the gap? And how do we, put some real urgency behind it? So, I mean, these, tools and instruments that have been developed are fine, but if all that does is just basically say, I pay to pollute, I'm okay, well, that doesn't get the world to where we need to be. So that sense of changing behaviors and the mindset that that Inyani talked about are very important. We can get very lost in our sort of world of reporting, but we have to understand it's there for a purpose, and the purpose is to make a sizable, meaningful difference to the impact that climate change is having across the world. Hilda, there's a question from MJ, sort of, who would like to know your opinion about the idea of equivalence between ISSB plus GRI and ESRS.
Good. That's the $1 million question, I would say. Now, you can have opinions and then you can have reality. And so what Neil talked about, I think that is a vision that, we would like to see. But I think Neil also pointed out that's not where we will get immediately. Because if we look at what we have in reality, as we already talked about, in Europe, we have those ESRSs. We do not have the ISSB standards as S1 and S2 that have been adopted. Now, for European Union companies, we do not immediately expect that there would be a move to the global baseline of S1 and S2, but what we very much are focusing on now, and where the discussions are still open and where there is an opportunity, is when we look at non-EU companies, you know, those with subsidiaries in Europe that have a certain turnover. And there, indeed, there is a possibility that Europe would set its own standard, European standards for the non-EU companies, or that there is this alternative of equivalence. There are two basic requirements indeed for this equivalence. It is that the approach is a double materiality approach. So if you look at ISSB standards S1 and S2, they would not suffice for a basis for equivalence. You need to add something else, and GRI, that is based on double materiality assessment, is your best choice to basically amalgamate. Now, there is in the CSRD, there is a list of topics that says that these topics need to be addressed before a standard or a group of standards or a combination of standards can be considered to be equivalent. When you put those two together, you get very close, but depending on the company's circumstances, there might still be a few of those 12 ESRSs that you might need to add, but the basis is there. Now, as far as equivalence, that is something which in European law is embedded as to how you look at this. And unfortunately, what based on our discussions with the Commission has become very clear, a company that says, I use S1, S2 and GRI, so that makes me have equivalent sustainability reporting, is not enough. What would be enough is that between the European Union and the jurisdiction where that company is, that there have been discussions and that this jurisdiction actually has transposed or adopted S1, S2 and GRI, and that with the EU, they have agreed on, you know, considering that to be equivalent. So there is this legal requirement that are the standards that are required in the jurisdiction outside of Europe, and there needs to be that agreement with the Commission. This is considered to be equivalent. So that has not been tested yet. So this is something that is also time consuming, and it is also something that asks for analysis, discussions. So there might be, you know, consideration of details that might still not get you to the full equivalence approach, as it has not yet been tested. When we discuss with the Commission, they are not having made any decision right now on what way they want to go, own standards or equivalence. They have, for the moment, both options open. As in more than half of the world in 2024, we have European elections next month. We will have new EU leadership in a few months, let's say in October of this year. These questions will come back then, and it will be with the next EU leadership that these questions will be discussed and hopefully resolved. So I would say the possibility for equivalence is still there. Whether we will get it for non-EU companies, well, we would hope it, but there is no guarantee for the moment.
Thank you. I'm conscious of time, so I just want to just cover one other aspect. Ihani, if I could just come to you, just to ask, how is the FRC of Nigeria approaching the issue of assurance of sustainability reports, and what challenges do you see with respect to the assurance?
Hello, thanks so much. Like you said, because of time, I'll go straight to assurance. However, I was interested in Hilda's response on equivalence and my thinking about what is happening between the global north and the global south in standard setting. I remember in 2001, when we were converging on IFRS, we had a lot of promises from Europe and America, and there was this project on convergence. All of a sudden, America backed out. We now have IFRAG censoring, in my word, all standards issued by IFRS Foundation. And the same thing is about applying in sustainability journey. And it creates a lot of concern for those of us from the global south, even in our discussion in Mauritius, who we are saying, what is happening? Wouldn't it be better to have a global baseline? Whether in Europe or in anywhere, we are playing in global village. Why wouldn't we have one baseline? Anyway, that's another day for discussion. Assurance, in our understanding in Nigeria, is a very critical part of the sustainability reporting journey. And we discussed seriously about it. In Nigeria, what we agreed is to look at two perspectives. Can these entities that are just joining now, would they have what it takes to do real assurance? So we now found solace in the work being done by the International Assurance and Auditing Standard Board, ISA 5000, and we looked at limited assurance and reasonable assurance. And we have in the roadmap for sustainability, we now say that for entities, anytime you begin the sustainability reporting journey that will allow you 2 years to report without assurance. Then the third year, you must have limited assurance, at least on scope 1 and 2. Then after the second year, you will be required to do reasonable assurance. So let it not be like the stories we hear, especially on our own side, corporate social responsibility reports, where people claim a lot of projects that have done that cannot be verified. So that's why we seriously look at assurance, following the assurance standard and following what the International Ethics Standards Board for Accountants are doing in ethics area. And we believe that when these two aspects are strictly complied with, we'll be having a semblance of true, permit my words, a semblance of true sustainability report emanating from this side. Therefore, assurance is taken seriously, and we built them in the transition process. Thank you.
Thanks, Henry. And of course, Josephine will be joining shortly, or she's already online, but we'll have the floor, so she'll be able to talk through the 5,000 standard and the plans for that. Hilda, just the same question to you in terms of assurance. What is the sort of European sort of position on this requirement?
Good. Well, we have for the scope of companies that I laid out earlier, we have required sustainability reporting. We also have mandatory sustainability assurance. We start with limited assurance as from 2024. Whether there will ever be a move to reasonable assurance is not yet determined. By 2028, the European Commission has to look at this, make an impact assessment, and then see whether at that time they want to move to reasonable assurance. But it has always been said that is the ultimate aim to get to. As far as standards then, the picture looks a bit rosier, I would say. For the moment, there are less initiatives there, there are less choices there. So the ISSA 5000 standard is, for the moment, very much the standard that the European Commission and with them our European regulator, the CAOB, is looking at the baseline for sustainability assurance in the European Union. There is no final decision on this, but that is currently what is being used as the basis to prepare guidance, to do a technical analysis for an adoption of a limited assurance standard by October 2026. So there is actually a good chance that there will be really a global baseline there, at least from the point of view of Europe. So we are actually quite happy about this development and how those discussions are going for the moment.
Good, thanks. So I'm going to bring in Josephine shortly because we've got many more questions that we could answer. We could spend at least another hour. But I think what the conversation that we've just had and what we've heard, obviously, earlier from Neil, shows is that we all need to collaborate right across the world to get this right. No one can go it alone at the exclusion of the others. And that's, one of the founding principles of, the GGA, which Mervyn wanted to achieve, which is to get us talking together about common issues that affect all of us and collaborate together to find common solutions that can address these challenges. So I think that's come out very clearly in the conversations. I saw how you were responding visually to Inyahi's comments that were made. We're not going to do it alone. We can't achieve it alone. We've got to go together, hand in hand, helping each other. And as Inyanhi says, everyone's at different stages. And the twinning arrangements that he talked about coming out of the Pan-African discussions last week, I think helping everyone, leaving no one behind, absolutely are the key messages that I think are coming out of the colloquia today so far. So with that, Hilda, Inyanhi, thank you so much. And let me now turn to Josephine, who I know is with us. So Josephine, good afternoon.
Good afternoon, Alan.
And welcome, and thank you so much. Sorry we've eaten into some of your time, but I hope you found some of the conversations useful
absolutely.
As we embark on your next session. So may I just hand over straight to you?
Yes, and thank you. And of course, it is an absolute pleasure to be here with such esteemed members of the group and the attendees as well. Really appreciate that. I do apologise. I was supposed to be on a little bit earlier, but ironically, my work laptop computer wouldn't let me load up Zoom, which is ironic because I'm actually responsible for technology at the FRC. So it was really quite alarming that the one thing I am responsible for wasn't working. So apologies for that. But so I'll introduce myself. I'm for those who don't know me, I'm Josephine Jackson. I'm Vice Chair of the IAASB and therefore also in fact responsible for the task force who are working busily away on the ISSA 5000, our exposure draft. I wondered if I would I wondered if we could share the slides, Carolyn. I do have a few slides, but don't worry, audience out there, not a lot, just a couple to go through, just to give us something to look at. You don't have to keep looking at me. Thank you so much. Yeah, so there we are. And again, thank you. So what I'm going to do is just do a little refresher on the whys and how. So why did we do what we did and how did we put it all together? And then I'm also going to cover very, very high level, of course, highlights of what we heard from our stakeholders during our outreach and of course at the end of the consultation through their comment letters. So if we could move on to the first slide. Okay, so this is kind of just setting the scene, why IAASB went ahead and actually approved the project. And you probably talked a lot about this today already. I'm sure Neil covered some of this. Sustainability reporting isn't actually new, of course, nor are the frameworks that have existed. I think the top of my head, I think GRI started back in 1997, actually, with environmental requirements. I may be wrong, so if there's someone from GRI on the audience, forgive me, but I think it was there. But when in about 2019, the IFRS Foundation was called upon by its stakeholders to become involved in reducing the level of complexity and achieving that global baseline, very much what we're talking about today. The IAASB were also prodded around the same time to think about a global baseline for assurance. Now, at that time, we weren't getting quite the call that others were being called. I think it was, whilst assurance is, as already been mentioned by Inyanhi, is part of that journey, everyone was focused at the time on the reporting side. So what we did, we worked on what we call ER guidance, which was taking our foundational standards to do with assurance and deliver an assurance engagement and build some non-authoritative guidance on top of that, so that if you're actually delivering some form of sustainability assurance, which of course has been ongoing for quite some time now, then at least you have the standard and then this guidance to help you through. But of course, as time moved on, it became much more critical for us, because obviously assurance has a key role, very key role in contributing to the reliability and trustworthiness, of course, of sustainability reporting. It became apparent that we did need to actually build our own standard, focus purely on sustainability assurance and build that global baseline. So so we worked through that, and our timing, as you can see, sort of matches quite nicely with Hilda's CSRD and ESRS. I always call them Hilda's. And so we issued our exposure draft. Actually, it says July. We approved it in June, and then we issued it just at the beginning of August, and then we had a closing date at the end of the year last year. So we're looking still for our target approval of that standard in September 2024, but a little bit more on that later. If we could move to the next slide. Thank you. Right, so this is, what is it? Well, it is actually an overarching standard. It's principles-based with application material, but it is suitable for all engagements of all sustainability information, and that can mean for any type of sustainability topics, all information disclosed about those topics, any mechanism for reporting. In some jurisdictions the sustainability information will be in the traditional annual report, and others it will be outside. It doesn't matter where it is, it doesn't matter if it's incorporated by reference. The standard is covering all of that. All reporting standards. So I already mentioned GRI, we've been talking about ISSB, we're talking about ESRSs. It doesn't matter what we call the framework criteria is, the standard still applies. And of course, all users and stakeholders. And that would often be directed by the financial reporting, I can't help myself, by the sustainability reporting framework, but also, the public and the public interests at large. Hilda was just talking about the fact that, and Aniani was also talking about the fact that, this is a journey. And whilst we know that there is plenty of assurance already being undertaken on sustainability information, a lot of that is non-mandatory, it's voluntary. But as we're moving into mandatory regimes, and in fact, Japan have also recently announced that they'll be moving into a mandatory assurance regime, the starting point is limited assurance. And so we wanted to make sure that the standard addressed that starting point, limited assurance, and then also reasonable assurance, because that's the journey, that's the transition. And in fact, in CSRD, there is a nice little quote there that says, which talks about this journey and thinks about when we're thinking about reasonable assurance, we're thinking about it in the same way we're thinking about an audit of financial statements. It's that kind of level that we're looking at. So clearly there's a journey, and though the standard addresses both of those aspects. It's a standalone standard, so you don't have to apply other standards. All our assurance standards tend to home back to ISA 3000. That's like a foundation standard, but this one, it works all by itself. And naturally, as with all our assurance standards, it is actually profession agnostic. You don't need to be an accountant. However, critical to that point about trust I was talking about early, you do need to make sure that whoever is performing this standard does adhere to ethical requirements and quality management requirements. So that's the standard. And, once 5000 is approved, it will be the only global sustainability assurance standard available to anybody who wants to use it, again, within the confines of making sure you're a subject matter expert and you apply quality management and ethical standards. That's very important. And so there we are already thinking about, from a global perspective, there won't be that fragmentation, because there will be this one standard ready to pick up and use. If we could move to the next slide. But I'm only going to really briefly cover this, because I obviously have an audience here with lots and lots of knowledge. But this is a standalone standard. But 3000, it was, I think it's 10 years ago when we approved 3000. So that's, you know, it's getting on a little bit now, and 3410 is around the same time, maybe a bit later. And so our starting point for this standard is really those foundational standards, because for equivalence and trust, you have to make sure that the provisions in 5000 are drafted using the same language as our audit and assurance standards. And this is important to maintain equivalence, again, across all sustainability engagements, but also when you're thinking about minimizing any kind of conflict between, if you are doing an audit, a financial statement audit, and you're doing a sustainability engagement, roughly those principles and provisions are all the same. We do recognize that some terms would need to change. I mean, and quite frankly, we'd have to introduce some new definitions, because the 3000 standard doesn't include definitions for sustainability, for example. So we've got 2, starting out with our principles, 1, bringing in defined terms. And then, of course, we looked at the guidance that we created in EER to bring in those where there are really quite a few challenges in certain areas. We brought that material into the standard. And then very briefly, as I said, 3000, 3410, quite old now. So we wanted to make sure we brought in the more recent thinking of the board. So we had to consider the auditing standards from that perspective. So we have brought in some principles, or we've adjusted some principles to take account of the more recent thinking of the board. And then, of course, addressing any other priority areas. So that's ultimately, that should give the audience comfort that we've not done something radically different here. This sits on the same foundation as all our assurance standard under that assurance framework, and it has been updated to take account of the more recent board thinking. So if we could move to the next slide, please. Thank you. Okay, so the very exciting thing is, who did we hear from? We heard from 143 of our stakeholders in formal letters. Actually, it was 146 in the end, and 3 came in late. So they're not on the official board, but we definitely have taken those letters into account in coming to some of our considerations and conclusions. And we also did an extreme amount of outreach, as some of you would have been involved in that as well. So we did that from August all the way through to the end of the year last year. And Tom and me and others sort of spread the love, as it were, and so that we would make sure we covered the globe. I basically did Australasia, and Tom did a lot of the Americas and Europe. So we really did cover off geographically our stakeholder groups from our outreach. And also, as you can see here, in terms of our response letters, we actually got a really good spread across the geographies and across our stakeholder type. Inevitably, we always find it really difficult to get preparers and investors, ironically, who we build these standards for, investors to respond to us. But the 15 here, along with all the outreach that we did, because at the roundtables we made sure we really got that investor input and preparer input. So together we've had some really good preparer, user and other user input to the standards. So if we could go to the next slide. Thank you. So ultimately, we got very, very strong support for 5000. In particular, if there's 4 things we've picked out here: the rapid speed of development. We were very agile. We were intending to actually put the exposure draft out at the end of the year last year. And in the end, we realized that there was an important and critical demand for this standard. So we moved very, very quickly. Obviously keeping our eye on the quality of our standard at the same time, but we managed to make it and get the standard out in August for exposure. And we've had calls to continue with that speed of development to make sure that we hit that September deadline. As Hilda mentioned, that's really important from a European perspective as well. And so that gives Europe time to contemplate and build in as hopefully ISSA 5000 into their assurance standard setting. There was a huge support for that global baseline. Again, it's really important to make sure that we are building a global baseline and we're not introducing any kind of fragmentation ourselves by developing lots of different standards, but we have one overall standard. So lots of support for that. Lots of support to make sure it's underpinned by ethics and quality management. Again, they're really, really important in terms of trust and confidence in the individuals who are performing the engagement. It's not just delivering in accordance with the standard. I always think of it as like a three-legged stool. So one leg of that stool is the standard itself, one leg is ethics, one leg is the quality management system that underpins it all. You take one of those, obviously the stool falls over, and so does the trust and confidence. So that's my sort of mental image of how I try and get across how important those are. And there was a lot of support for the standard covering the entire engagement as well, from soup to nuts, as some people say. If we could move to the next slide, thank you very much. And now, inevitably, it's all good news, but there are areas, of course, we needed to work on a bit more. And those areas we ended up grouping into themes. And also these themes that you see here are actually consistent with what we heard through our outreach activity, as well as through the comment letters. So there may have been some nuggets either side, but ultimately these are the areas that we needed to have another look at. So in terms of scope and applicability of the proposed standard, now here I am, I'm telling you that the sustainability standard is there for all sustainability matters, all topics related to sustainability, any kind of disclosure related to sustainability. And yet, if you're dealing with greenhouse gas statements, we said in our exposure draft, you have to pop over to 3410. Which is our greenhouse gas statement assurance engagement standard. So not really achieving our aim of making sure that everything to do with sustainability could be covered under one standard. So that was very clear feedback that we hadn't quite got that right, and absolutely spot on by our stakeholders for pointing that out. And our stakeholders therefore suggested that what we need to do is we need to incorporate requirements of 3410 or those that we haven't incorporated already. As I said, we've already built 5,000 based on 3410 anyway. So incorporate that material into 5,000, and then that way there's only one standard, whether you're doing emissions. I think it was mentioned that earlier in our Yanni, you mentioned the fact that you'd be doing scope 1 and scope 2 first. Normally you'd have to pop over to 3410 to do that, but now all of that would be under this one standard, which is much less confusing for people using the standard. In terms of sustainability matters, information and disclosures, that's really more about the definitions. Interestingly, people were quite happy with our definitions, except we had actually tried to modernize the concept of sustainability information, taking some of the more recent nuances, for example, thinking about culture and the importance there, thinking about not just impact and risk, but also dependencies and so forth. So we tried to bring in, make it broad and bring in many things. And then ultimately our stakeholders, and this was very loud and clear, said, you know what, we just like ESG. It's really straightforward. I know that ESG incorporates all these other bits and pieces, but just keep it simple, because this is the language people are still using. And so we had to readjust some of our definitions and get back to what I guess we would call get back to the basics. And, as time moves on, as we're all learning, we're all on this journey together, all of us together, and which makes it all very exciting. So as things change, we might have another look at that later in the future, but ultimately we were told to rein it back in and just keep it nice and simple. Relevant ethical requirements and quality management standards, as I've said, everybody's 100% behind that. They think of my three-legged stool and realize that that's very critical, but it's complicated because if you're not using the IAASB's quality management standard, or if you're not using IASB's ethical requirements, but you are using your own, what does that mean? They have to be, in our standards, they have to be at least as demanding. How do you do that? How do you make that analysis? So our stakeholders were saying that we just need a little bit more in the standard that just guides us. The two things we need is what are the critical factors in the quality management standard that you need to embed in order to say that your quality management standard, whatever you're using, or quality control standard, is at least as demanding. And what does that mean? And so we brought in some extra material to explain what the real critical factors are in order to achieve that at least as demanding point. And the other piece that we were asked to acknowledge is that ultimately it's down to local standard setters or your local authority like the FRC in the UK or the FIC in Nigeria or wherever that might be. It's up to them to determine what is at least demanding if they have not adopted those standards themselves. And then, of course, when you think about the fact that this is practitioner agnostic, so a lot of those practitioners out there will apply ISO 17029. I think that's pretty, yes, I'm pretty sure it's 17029. So that's like a quality and ethics standard. So, you know, is it equivalent or not? So there's an exercise actually going on to work through this and make that analysis. But it's really important, at least in our standard, we give some kind of guardrails as to what that means. Materiality, everybody's favorite topic, of course, maybe not for those in the audience, but it generally was, and any kind of outreach that we did. A few strands here. First, materiality from the preparer's perspective. So the entity's process, or the process that, let's say, management goes through to determine what topics are material topics and therefore should be reported to their users, is an implicit aspect of the assurance practitioner's evaluation when they're performing an engagement, but it's not explicit. It's not explicit in the exposure draft. And that caused a little concern, and particularly given how important it is, because a lot of that decision in the financial reporting world, which is so much mature, obviously, some of those decisions have been made for the preparer, but in this world they haven't. And so it was really important for us to explicitly point out that the entity's process, whether or not the entity should have a process, so one, consider whether they have one, and secondly, if they do have one, it's important that the practitioner evaluates that. So we've introduced some new requirements to address that. And that also deals with some concerns that we heard from our European colleagues, where they're worried that if you go through a process, what if it's not complete? What if you've missed a material topic and as a preparer and you feel like you've done everything you should have done, you've got the right stakeholder engagement to work out what those material topics are, but there could still be something you've missed. And so that completeness issue needs to also be considered not only by the preparer, but also the practitioner. So we've introduced some guidance for the practitioner to think about that. Hilda mentioned the wonderful double materiality. Double materiality exists in a couple of frameworks. It's very important, but we did not recognize it explicitly in our standard because it's not a it's a reporting requirement as opposed to an assurance requirement. However, we do have requirements to consider materiality, and therefore to ease some of the concern that the practitioner may just completely miss this, which is unlikely, one would hope, if they're a subject matter expert and they have the competencies and skills. But we do understand that there is some concern around this. So we have now introduced a requirement for the practitioner to take into account different considerations if the framework itself requires double materiality. And then the other piece of materiality was just that we kind of squished up and mixed up the preparer's perspective on materiality with the practitioners in the standard. And so that was causing lots of confusion. So we have tried to adjust for that. A couple of other points, the engagement team using the work of others and group engagements. Group engagements, we really wanted to make this principles-based. It's a global baseline. We recognize that in time, there will be a need to maybe develop more performance-based standards. So we might, materiality, for example, we might have to develop ISSA 5001 on materiality because of the complexities and the additional requirements needed. We may, and we recognize that. So our thought in terms of groups was that provided we have the principles, then we don't actually need too much information on groups, but that didn't quite land very well. Our stakeholders on the whole were comfortable with where we went, but others really felt that we just needed a bit more meat on the bones. So what we've done is we've introduced some new requirements around planning considerations. So your thought process when you're dealing with a group as opposed to a single entity is different when you're going into the engagement, and that occurs at the planning. So that thought process and things you might need to think about, we've introduced into the requirements. There's also communications, so you may not have exactly the right number of people in your engagement team to perform the work, or in your firm, sorry. You might have to reach out to, you know, pick your other favorite practitioner to help you to do some work and gather some evidence. So we've introduced some more aspects of communication between those parties and so forth. So we've added some more just to, you know, ease that concern that perhaps it was a little bit on the lighter side. And then finally, the other thing that we were picked up on is that the limited assurance bar was way too low, and that's primarily because where we'd entered it at a very basic level, but in fact the reality is it under 3410, which is our emissions standard, the limited assurance bar is slightly higher. You have to look at the you have to consider risks and material misstatement at the disclosure level when you're looking at emissions. So why would that not apply to sustainability information as a whole? So there was quite an overwhelming push for us to raise the bar. So we have done that, and we've introduced limited assurance, which is a risk-based approach at the disclosure level. But again, you know, I always say, don't panic. It's the disclosure level. It's a really high level. It's not like reasonable assurance where you're getting down to the individual assertions based on the individual disclosures, which is a lot different. And with a limited assurance engagement, you're not looking for material misstatements. You're just determining where they might happen. Whereas in a reasonable assurance engagement, you are looking for material misstatements. You're making a call, a judgment call that I think they will be in X, Y, Z at these assertions, and therefore I have to get the evidence to prove that they're not. Whereas limited assurance is really around nothing coming to your attention. So whilst it raises the bar, it only raises it a little bit, and it just makes it consistent with 3410. I could talk about this for hours, but I'm not going to, don't worry. So the educational materials piece at the bottom, that should really be one of those wonderful animated things that just keeps cropping up. I've given you these themes and these ideas, but ultimately at the end of the day, we heard very, very positive things about the standard, and just calls for guidance, more guidance, please. This is a whole new area. And so what I'm going to do is I'm going to talk about what we're going to do in response to that, because that was actually by far the loudest message. It was a lot louder than, can we talk about entities risk assessment process, risk process, entities materiality process, can we talk about risk assessment procedures? By far the loudest noise here was, we want educational material. This is just a little bit on the right-hand side there to remind participants that we've got some other bits and pieces that we need to talk about in our June board meeting: estimates, fraud, reporting and communication. Obviously, they're important topics, but there wasn't a huge amount of push for change here. They were just clarifications, some additional material required, and so forth. So the big themes we dealt with in March. So if we could move to the next slide. Sorry, Alan, I'm taking a bit longer than I promised I would. I apologize. So here we are. So the educational piece. Now we have for always, when we've delivered a standard, approved standard, had a basis for conclusion. And it gives you a story about what the board were thinking and what were the key things they wanted to cover when they developed the project proposal, how they dealt with that, some of the key things they heard on exposure, how they dealt with that. And that's the basis for conclusion. So it helps you understand the journey of the standard. We all get, but usually we also, more recent history, have produced first-time implementation guides. And the first-time implementation guides normally come out anywhere between a year and 18 months after the standard is released. In terms of this standard, that's too long. And that was the loud and clear I said about the educational materials. So I agreed with Tom that we would put out our first time implementation guide for this standard at the same time the standard goes out the door. So you'll have three pieces all at once: the basis for conclusions, first time implementation guide, and the actual standard, as well as already we've done an FAQ on materiality. And then what we'll do is we will then start to develop other non-authoritative guidance as we start getting feedback at some of the areas that people want a little bit more on. Can you give us a little bit more on, I don't know, the risk assessment and so forth? And then the other thing we want to focus on is non-authoritative guidance on quality management. We did a first-time implementation guide on quality management standards, but what we thought might be useful for non-accounting practitioners who may, you know, some have adopted, but majority haven't, you know, give them the, if you're performing sustainability assurance, what does a quality management system look like to you in that environment? So we're going to build some guidance on that. And then if we can move to the next piece, next slide, please. I think there's the next slide. I'm hoping there's the next slide. There we go, yeah. So an important thing is that, you know, I'm sort of sitting here and chatting to you about, you know, a technical standard here, but I think 5,000 essentially isn't just a technical exercise. Yes, of course, assurance standards have a lot of technicalities. You know, they require subject matter expertise. They require a very deep understanding of the procedures to implement. But effectively, what we're talking about today, and you've spoken about it before I joined, is the future of the globe and the global economy. And we're at the advent, all of us, as Alan says, of this new era of external reporting that includes both financial and sustainability information. And we should be under no illusions, therefore, that decisions that we make today about this fundamental infrastructure will have a huge and long-term impact and give us huge opportunities to make, of course, our economies work better in a much more sustainable fashion. So if we make choices today that are not in the broad public interest, then we will have a really hard time reversing those in the future. So in my mind, and this is my opinion, but I'm pretty sure it's much of my board members' opinion as well, we have to always think about the public we serve, and the public interest requires a system that one, enables global comparability, two, encourages the development of a profession capable of producing and assuring high quality reporting, and three is, of course, that unwavering and unapologetic, I would say, commitment to quality and rigor. So this is an ambitious project to develop this globally accepted standard by September. So this is why it's so critically important we have this ongoing engagement. For exactly those reasons, we have to really make sure we stick to those three priorities and make sure we do commit to quality and rigor. So it's not just as simple as us taking those comment letters and off we go and have our interactions with the board. We're consistently and continually talking and doing this outreach as we move to September. And yes, so as I said before, we're still, as I say, looking for a September deadline, fingers crossed. And if we can move to the next slide, I believe we are in conclusion. Yes. So Carolyn, Alan, any questions? And thank you, everybody, for taking the time to listen to me today.
Thank you very much, Josephine. It's very, very insightful, and it's great to see the updates. So when Tom last spoke at our previous colloquium, it was all in the early days before you'd even publish the exposure draft. And now here we see the results. So thank you very much for this update. We've got a couple of questions, and I know that we're short on time, but the first question is really around the topic of colloquium is equivalence. And what if equivalence is something that concerns assurance standards, and if the IAASB has an opinion or position when it comes to equivalence?
Well, you know, we've always been of the view that ultimately you're trying to aim for globally accepted standards, because ultimately, again, you don't want that fragmentation. It's about consistency in what you're reading, you're assuring, etc. And so, you know, equivalence is really important. From our perspective as a standard setter, and our standard, which at that sort of technical level is the only thing we can say is that the assurance practitioner is obviously going to have a harder time if they're trying to look at three different frameworks with the preparer and try and work out, well, if we're looking at GRI and we're looking at ISSB and we're looking at ESRSs, how does this all fit together? You know, that makes things more difficult for the assurance practitioner. But the standard does let them do that, and they have to, and the practitioner goes through the process. They look at how management have gone through that process, and working with management to come to a conclusion. It's around that completeness and relevance point that I was mentioning earlier. That's really important. So from the standards perspective, it is flexible enough to be able to do that. And of course, in terms of our first time implementation guide, that was one of the things that we said that we would talk about, that you will have, I think another speaker mentioned it earlier, you will have situations where you might turn to, I don't know, GRI to fill in some of the gaps in ESRS. I'm making it up as I go along. I'm sure you understand, but, you know, and so giving an example of that will be really important.
Thanks, Josephine. So here's somebody who wants to be qualified in ISSA 5000 eventually when it comes out and you've got the education material. How would they go, and then not a current financial auditor, how would they go about doing that? You mentioned the 3 components of the milking stool as well. But how would somebody who wants to be qualified as an auditor, who's actually say an environmental practitioner today, how would they go about doing that? Do they need to go through all of the rigor of becoming a financial auditor before they get to this point?
No, not at all. I mean, I did mention earlier that ultimately, you know, this is not what we're talking about today. Is not just the technical exercise. You still do have to have that subject matter expertise. You can't, you know, you can't be an assurance practitioner in a topic that's completely unrelated and have absolutely no knowledge or skill in sustainability matters. So, you know, your starting point has to be that you have skills and competencies in sustainability matters. That doesn't mean you have to be able to do an audit of financial statements. It is literally those skills and competencies there, and broadly as well, because it's all sustainability matters. And you do also have to have assurance skills and techniques. So you have to be able to perform an assurance engagement. So that's what I was talking about, having a deep understanding of the kind of procedures that you would need to implement to perform that work. But that, you know, that is the very high bar that's expected of individuals who are performing this work. Otherwise, users out there can't have the trust and confidence in the assurance report that's being delivered. And then in terms of the quality management standards and in terms of ethical standards, that's right. Every assurance engagement has that underpinning of quality management, which is the foundation, which gets you to the point where you get those skills and competencies. And your ethical standards are obviously very important. So, but you don't, you just have to be able to apply those that are at least as demanding. So in the UK, for instance, I could talk about this for hours, but in the UK, we don't actually adopt the ISBA code. We have the FRC's UK ethical standard, but it is at least as demanding as the ISBA code. In fact, it goes slightly further than the ISBA code. So in terms of UK practitioners, they don't need to worry about the ethical standards. They have the ethical standards they need that underpin that.
Thanks. Last question, and then I'll call on Neil, Hilda, and Inyani. The ISSA 5000, how does that relate with internal audit engagements?
By internal auditors on that particular. So the best way to think about it is that it's like thinking about it from an audit perspective of financial statements. So ISSA 5000 will draw on the internal audit function to assist them in understanding the sustainability topics, the internal controls within the organization, particularly in terms of preparing the sustainability information. So the assurance practitioner would reach out to the internal auditor within the organization to support them in delivering their external assurance. And it's the same in financial reporting as well. You can very much reach out to internal audit, and often it's you know, they're one of your very important components of the whole management system internally within an organization, or the whole control system within an organization, because they're also looking at similar matters. They're looking at where things might go wrong, where misstatements might occur, and they're probably looking at it at a much deeper. They are, in fact, looking at it at that much deeper dive level than the external assurance provider will be doing. So that's how the interaction works.
Thanks very much, Josephine. I've got a question for Neil, and Neil, I should have posed this to you before, but it's a question around, I guess, a single data schema, so to speak. So the question is, will we see a common framework of for data in future?
At the level of the preparer, or the in system, I mean,
Across the standards, I guess, a single data schema.
Well, I mean, there are a number of ways of looking at this. I mean, certainly in terms of the reporting taxonomy digital tagging, then both the ISSB, they've already issued theirs, and ESRS are already developing theirs, and one can see hope that that is a way of encouraging more interoperability, because you can actually see where the same types of information are in the different reporting, so that could actually be a useful way of at least identifying where relevant disclosures are made. I'm sure there will also be, looking at more from a solutions perspective, systems and processes solutions perspective, I'm sure there will be sort of consultants looking to enhance the types of enterprise technologies that are available to companies to sort of support that, so that the idea being that you can prepare data that can serve a number of different reporting requirements. So I'm sure that will be in the mind of those providers. I'm not sure how else to answer it. I mean, we could also discuss the ESG indices and benchmarks if that's useful, but I'll stop there for a minute.
Thanks, Neil. I've got a question here for Hilda. Hilda, are you online? Great.
I am.
So apparently Alan made an excellent point. Interesting to see what happens with the data that's gathered from the 50,000 plus companies that Hilda referred to. But Hilda, there's a requirement for companies outside of the EU to report in terms of scope 3, in terms of the reporting, and there's something about a 2029 reporting requirement. Are you able to explain a little bit more around that?
So indeed, so non-EU companies will have sustainability reporting requirements if they have a branch or a subsidiary in the European Union that has more than 40 million euros of turnover. So the group itself should have more than 150 million euros of turnover worldwide, and they have the subsidiary which has more than 40 million, then they are caught by the CSRD. And indeed, the first year they would report would be over the year 2028, and they would issue this in 2029. So that is indeed the framework. The big question that is still open, which standards will they use? So the focus of their reporting would be on impact. So that's this double materiality approach that is being looked for. It would be reduced from what we currently have in the 12 ESRS, but it has not been determined yet whether there will be own European standards set for this, that this is what you need to use, or what we discussed today, you know, the equivalence route would be something that really comes to the forefront and can be used more and more. That's open, and potentially after the EU elections in June, towards the end of the year, this will be back high on the agenda in Europe again.
Thank you very much, Hilda. And I know we're running out of time, but Josephine, you said you could answer Lynn's question around greenwashing and linking greenwashing to fraud, and your thoughts on that.
Yes, that's absolutely, I'm happy to do that. So interestingly, so greenwashing, green hushing, rainbow washing is basically, you know, it's not defined anywhere, but ultimately it's when information is going to be misleading. And we all understand that. And when it's misleading, it's because there's been a bias, and that can be through metrics, it can be through disclosures, but there is bias. Now, we call that in our world, that's management bias. But bias can actually be unconscious or unintentional, as well as intentional. And where the link to fraud comes is when it's intentional, when they've thought it through, and there's been an absolute intent to greenwash or green hush, then it's fraud. Now, what happens in an assurance engagement, once that bulb goes off, it's an intentional, it's fraud, then you have to stand back and look at your entire engagement again. So if you really believe, and it's quite obvious it was unintentional, it's like, oh, whoops, yes, good point, let's just change that straight away and off we go. But then that's fine. But any kind of indication that there was an intentional bias, then it's fraud, and then you stand back and you rethink your whole risk assessment, and you have another look at everything as a whole. So that's how we link it. But we don't use the terms, but ultimately it's bias that we're thinking about.
Thank you very much for that. And now I must conclude. And now I've got questions from Yanni, and I've got questions for others. There are more questions in the Q&A. What we'll do is we'll take the Q&A questions that haven't been answered, and we'll circulate them to the panel, and then post them on the answers on the web page, the event web page. The video recording and all of the presentations will be made available on that page as well. But if I can, please call on Alan now to close our colloquium, and thank everyone for being online today. Thank you.
Thank you, Carolyn, and may I also add my own thanks to all of you for joining the 11th colloquium, for your insightful questions to the panel and the speakers, and of course in the chat, which I've been sort of looking at during the course of the last 3 hours, for sharing your own thoughts and your own experiences, which is very helpful. We all learn from each other. We started with about 350 participants, and we are now at 300. So I hope the fact that so many of you have stayed on demonstrates the relevance of the colloquium's topic today and the quality of the presentations. So on that, I'd like to, of course, thank our keynote speakers, Josephine and Neil, and to our panelists, Hilda and Ihiani, for their contributions, for the preparations and the significant amount of time you've taken to be with us today. Of course, I must recognize the tremendous effort of and the work of Carolyn Chalmers, the CEO of the GGA, her tireless work over many years, leading the GGA with limited resources, I have to say, and the significant impact that this is having right across the world. So thank you so much, Carolyn. But of course, none of this would have been possible without the vision and the passion of our patron, Professor Mervyn King, who established the GGA and started the colloquia 5 years ago. Mervyn, you've provided significant thought leadership across the world on very important and relevant issues, on governance, on behavior, on ethics, in business, and of course in the public sector as well. And I, for one, like many sitting around this colloquia today, have been inspired by your passion, your unwavering commitment. And this, I have to say, helps me hold myself to the highest standards of ethical behavior and try as best as I can to discharge my own responsibilities, both as an executive in the past and as a non-executive director today. So Mervyn, thank you very much. So today we focused on the future of sustainability reporting, on standards convergence and assurance. But as has come out of the conversation today, it is not just about the reporting. It's much more about the tangible actions that we all need to take to ensure that sustainable businesses lead to a sustainable planet. That will mean more equitable and inclusive societies for everyone, not just for the few. We all clearly need to enhance our commitment to sustainability, both the actions, the reporting, and the independent assurance that we've talked about, using, of course, appropriate international standards, supplemented by necessary regional and local add-ons. So I hope that the impact of the colloquium will continue to shape the future of our society. And we all know that we get the best outcomes when knowledge is shared in diverse settings and where there is broad representation from society. So as I said, we started with 350 participants representing more than 30 countries from across the world, Australia, Sudan, India, South Africa, Egypt, Denmark, Japan, Zimbabwe, Malaysia, Botswana, Singapore, Qatar, Canada, Netherlands, Lithuania, Rwanda, and I can go on. Lots and lots of very important countries that are facing significant challenges from the impact of climate change, sitting around the table to listen to each other and learn from each other. That is so powerful if we're going to make an impact and a difference. So thank you again for being here today. I look forward to seeing you all at the 12th colloquium in November. For now, all I can say is please stay connected with the GGA, do what you can to continue to support us, follow what we do and contribute to what we do, because none of us individually has all of the answers, but collectively we certainly do. And together we can certainly make a difference. So thank you very much and have a good rest of the day. Bye-bye.